Hi, everyone, and welcome to Strategic Wealth Strategies with our host, Alan Porter. Alan, how are you? We just continue to learn about specific ways to save people money on taxes through retirement planning, through, I guess, just knowing you now, because there's so many ways now to be able to save money and especially learn the whole financial process because it can become very complex at times.
Well, Neil, what I have a passion about is showing people the financial strategies the wealthy have been using against us, the banks have been using against us for years. And as I've said before, this stuff should be taught in high school, but it's not. It's not even taught in college. And I find it amazing because I talk to people who have doctor's degrees in finance, so they don't know what I'm talking about because they're always listening to the mainstream. Well, I teach people to think outside the box. And today I want to concentrate, everybody on the tip of their mind about student loan forgiveness. I don't think it's going to happen. But here's the thing. People got to get to college first. So I want to show people how to set up a correct college funding plan. Okay?
All right.
All right. Well, let me go to a PowerPoint. This is a short PowerPoint I put together.
All right.
I ask people, college funding, what is the best plan? Okay. The main plan out there, it's a 529 plan for the government sponsors.
Mm-hmm.
Well, what I do is I have what I call an SDIC, a specially designed insurance contract. And I will show you how this is a much, much better way to finance college. Okay. There's 5 potential problems with the 529 plan. There's probably more. You have risk because you're involved in the market. And let's say you're back at 2008 and you've got twins that are going to go to college and you've got $100,000 in that 529 plan. And the next year you got 50,000 because you just lost 50% in the market. Your plans are changed entirely. You have the performance of the market. It may be a bear market. It may be a bull market. You don't know. And here's a big thing people understand. It counts against financial aid. When you're trying to apply for some type of grant or something like that, it will count against you for financial aid. Flexibility, accessibility. It's very, it's very point to point to point. If you don't, let me get that back. If you don't use that for college funding, for higher education, it's a 10% penalty plus all the taxes. Mm-hmm. Recyclability. You can use it for other people in your family, but the thing is, you're stuck with that plan. That's the only thing you can use it for. And again, I said, if you don't use it for that, it's a 10% penalty plus all taxes. Are your parents saving for college or investing for college? That's a big question that people need to understand. Because if you're saving for college, you'll do the following. The characteristics, your money are not at risk, like they're putting it into a CD or a savings bond or something like that. Low risk, very low growth rate, probably maybe 1 to 2%, maybe.
Right.
Conventional plans, probably conventional plans, this is where you're investing. You invest in mutual funds and stock investments, and they have great, great risk. Dollar cost averaging over a longer period of time may work out in some cases, but you're always going to have a risk. It's just like what I teach people in tax-free retirement. In a 529 plan, if the market goes down, you may or may not get your money back by the time you need that money to go to college. And as an example, if you have a 50% loss in the market, it takes 100% gain just to get back to even. And it's just like in 2008, we did not get back to the even until the fall of 2015. Well, that's 7 years. Your kids have gone and now possibly going in for a doctorate degree now. The standard approach, a state-sponsored 529 plan, it's a great plan. It's better than nothing. Advantages, your returns may be significant. The distribution may be tax-free for approved higher education expenses. Plans may be moved amongst family members. A state income tax deduction may be available for some contributions. The plan only counts against you for aid at the parent asset level. It's not for the child. It won't count against them there. But here's the disadvantages. It's not guaranteed. You may lose money. No benefits if there's no growth. The more you save, the less financial aid that you will qualify for. Money must be used for college or a 10% penalty and all taxable. But the thing is, you must have time for growth. And this is something down here, the Uniform Trust Minors Account. It's just something that another thing that goes into college planning, but I've got something that's much, much better than that. A better college savings alternative is cash value life insurance, an IUL, index universal life, or a whole life insurance policy. And why I say this, here's the advantages. It's a safe investment with a guaranteed internal rate of return. And that's guaranteed by the insurance companies, which are the highest regulated industry in the world today, bar none. Death benefit as a hedge against the unthinkable that is tax-free. Now think about this. Let's say that I bought a plan for my grandson or son, and I put $100 a month into it. And I'm an older guy, but if you're a younger person in their 30s, $1,200 a year will probably sponge you with $100,000 of life insurance. And if you get, if you're killed in a car wreck, your son's college is paid for. But even that, for a little bit more than that, it's $500,000 of death benefit. But it's self-completing. Cash value amount sheltered from the financial aid form. It doesn't count against the financial aid. So you can apply for any grant or any subsistence that you need. And it's not going to count against you. You have the ability to borrow money from the policy. You don't have the ability to do that 529 plan. You can borrow this money from the policy and pay it back. If you don't pay it back, it just comes off the death benefit. It's tax deferred growth, and it's tax-free withdrawal upon when you need the opportunity. You don't have to wait to a certain period, and you don't have to use it for higher education. You have unstructured loan payments, and you become your own bank. I show people how to become their own bank and pay themselves back the compounding interest instead of the financial institutions. As Einstein said, those who understand compound interest will benefit from it, and those who don't will pay it. And Neil, it's just like my Debt Free for Life program. I show people how to pay themselves compound interest and not the financial institutions. And again, it's self-completing. I've got these plans started for children when they're first born, because when you do this when they're first born, the cost of insurance is much less. And you can fund a college plan for maybe $100 a month for somebody, or $50 a month when they're babies, because the cost of insurance is so small, and people do not understand this.
Wow. So you're telling me, Alan, that you can get a life insurance policy for a baby?
Oh yeah. In fact, about 2 months after they're born.
Wow.
They just have to have a social security number.
And so basically, and that's where, again, the thing that you've talked about on the show is you become your own banker. So if you put, let's say, 2, 3, 4 grand into this, and you need to take money out, you could take money out of the death benefit, and you don't have to pay it back. The interest will end up being paid for if the death benefit was paid out, right?
If you take a loan out and don't pay it back, it just comes off the death benefit. Now you have to pay interest on that, but you're getting hundreds of thousands of dollars for pennies on the dollar.
Compared to a financial institution where you have to, if you're going to get the loan, then you can't go take the money out, right?
Right.
And still be able to take the money out and yet still be okay. It's a pretty good deal.
But it's got so many other benefits. It avoids probate,
yeah.
And I explain what probate is. It's a lawsuit that's initiated by you that you're going to pay for and you're going to lose, because the government decides where your wealth is going to. It's protected from lawsuits, liens, and judgments. This is great for doctors. It's great for everybody, as a matter of fact. But there's no limit on how much money you can put in one of these plans. Now, there's limits on how much you can put in the 529 plan. But the thing is, it has so many benefits. It grows tax deferred. You get your money's tax free. It does not affect taxation of Social Security, the means testing, Medicare Part B. And that's if, here's the thing. If this child has this policy and continues it, and then pays herself back, or if it doesn't, and it keeps growing, think about that. They have their own retirement plan set up when they're the absolute youngest, and they can contribute to it after they get out of college. It's paid itself back with the premiums. I mean, not with the premiums, but the interest that it draws from the indexing strategies, or the guaranteed interest from the whole life insurance policy. But think about this. Okay, I'm 30 years old now. I've graduated from college. I've still got money in my SDIC. Now I want to take this over It was in my father's name. Now I want to take this over. I'm going to become the owner, and I'm going to contribute it for my retirement. And you can retire when you're 50 years old or 45 or whatever. But it has so many different advantages that people do not understand, and they need to be educated on this kind of stuff because they're not. Cash value life insurance, annuities, retirement accounts, and home equity do not account against you when applying for college aid, but a 529 plan does, and people do not understand the importance of that. A great solution for college and retirement index universal life or whole life insurance. And I've tried to explain this to people time and time again, especially on the podcast. There's no other financial vehicle out there that's legal that's going to give you all the benefits of an SDIC, especially design insurance contract, whether it's a annuity, as an example, annuity. We did something the other couple of weeks ago. You'd only have to have 2/3 of the money in certain fixed and fixed indexed annuities to give you the same 4% distribution rate that a $1 million stock portfolio would give you. As an example, you don't have to have $650,000 in that annuity to give you the same amount of money in that $1 million stock portfolio. And the benefits, they don't talk about the benefits. You always hear these pundits on the news, Edward Jones, Merrill Lynch, and all these others.
Yeah.
They don't tell you about this stuff because they're fee-based, and they lose money when you take money out.
Oh boy.
But think about this. You have long-term growth, stability of principal. You have predictability. It's friendly to financial aid. You have guaranteed loan rate. Participate tax-free loans. A multi-benefit tax-favored plan. And I've got a white paper. It has 29 bullet points, and I think I've sent that to you before. Again, you're protected from litigation in most states, and I think it's all states now. And here's another thing. Can be used for long-term care.
Yep.
Because it carries over. It's self-completing. And I've told you about long-term care. 70% of all Americans are going to need long-term care at some point in their life.
Yeah.
And it costs me $50,000 to $200,000 a year. It goes up every year. This is just a short PowerPoint, and I want to thank people to watch this. If they have any questions, you can always reach me at 910-551-1046, or my email, which is strategicwealth, the number 0 @gmail.com. It's right here in the corner of my screen here. But Neil, these things that people just need to understand, because they don't. They need to think outside the box. The debt-free for life. If you've got college debt, and there's billions of dollars in college debt out there, give me a call and I'll show you how to get out of debt.
Exactly.
The compounding interest and not the financial institutions. But it's all a part of knowing the facts, the figures. This is mathematical, economic, and scientific facts that taught to me by the experts. It's not the opinion. Now, I have my opinion, but that's not the opinion of some financial advisor with Edward Jones or Merrill Lynch or somebody. These are the PhDs in retirement, and also that know these products like the back of their hand. They're not associated with any company, and they don't sell anything, but they know what these products do. And that's where I get my information from. This is why I'm so passionate about what I do.
You're totally passionate about it, Alan, and it was such great information again. And start saving for retirement today. So when someone, a loved one, get a life insurance policy, contact him, especially for your new child on the way, then you're already saving for the college fund compared to the other ways where you're contributing and you have that money available to you if you need it, if God forbid a rainy day. And you can pour more money into that. So let's say the policy is a certain amount, you can build it up, right? If your things are going better. You might have a child and not have much money to contribute, but then 4 years later can put a lot more in, right?
Exactly. I'll give you a perfect example. Now, I had an oral surgeon. He makes a lot of money, and they just had a baby. And I said, "Can you afford $1,000 a month?" He said, "Yeah, if I can't, my father will." And I said, "Now, that's an extreme case because most people can't afford $1,000 a month." But I said, "Okay, now pay on that for 22 years. You never have to pay on it again. You're the owner. She's the beneficiary." I said, "How much money is she going to need?" He said, $300,000. I said, "Okay, at the age of 19, I want you to take out $50,000 a year, $60,000 out a year for 5 years. That's your $300,000. I said, now, when she's 40 years old, her college is paid for. The policy keeps growing. When she's 40 years old, she can take out $100,000 to do a down payment on a house, take a trip, or do whatever she wants to. But at the time she's 61 years old and she never contributed anything else, you paid on this for 22 years. Her death benefit is almost $10 million, and her tax-free income in retirement is over $400,000 a year.
Some big stuff, Alan. We appreciate it. Again, everyone needs to call you at 910-551-1046 or strategicwealth, the number 0 @gmail.com. Appreciate it, Alan.
You bet. I appreciate you, Neil. Thank you
All
very
right.
much.
That was the strategic wealth strategies, guys. Take care.